Thank you for taking the time out to join us today. It's been quite an eventful November for the markets. We've had quite a number of highlights, including that spike we saw to 35,000 points. We had earnings from the banks, and of course, we had a flight to safety from the fixed income market. But how would you summarize November?
Okay, so I think November was filled with a lot of market activities, and particularly in the equities market. It's no news that we've seen a lot of domestic participants, and we've seen more domestic participation in the equities market, currently about 70%. And, the lower yield environment, like you mentioned, the fixed income market, as, yields are currently unattractive in the fixed income market, and we've seen investors looking into other investment securities to get positive return. Just a bit of context. At the start of the year, we had yields in secondary market, that's bond yields, trade at roughly at 10%, while the T-bills yields was currently at previously at 4%, and what we've seen so far is it has declined significantly. And also considering where inflation rates is at the moment, I think 14.23% for the month of November, that just paints a picture of negative return. So what we've seen is that investors are looking to get positive return by going into the equities market. Another thing that has impacted markets so far in November is that the market is awash with liquidity. For context, we had about 1.2 trillion naira mature we had about 1.2 trillion naira mature from the NTB and Omoleg, and we saw that. I think that a significant portion of that went into the equities market, and that's why we saw the rally. And in terms of sectoral performance, we saw gains. The cement sector gained about double digits, and also telecos as well increased about 17% during the month. Breweries as well, we saw the rise of about 14% over the month, and that's just because a lot of investors are looking to they're looking at stocks with possibly good fundamentals, and also stocks that has like better chances of giving them higher return in the period. And I think that's what played out for the month of November.
And just looking at the month-to-date performance, that I suppose gives us a clear picture of where investors are putting their money and where perhaps they also have the most confidence. And I think you already mentioned one of them, that the NSE Industrial Index up over 24% so far, banking up just 8%, consumer goods 9%. I'm just wondering, it would appear that the fixed income market, what's happening there, has ushered in a new trading dispensation, if you will, for lack of a better phrase, at the equities markets. But I'm just wondering, what kind of shape could this take in 2021 if liquidity levels remain high and we do continue to see those depressed yields at the fixed income market?
Well, should liquidity levels remain high in 2021 and yields remain depressed in the fixed income market, we might likely see this trend continue for the rest of 2021. I mean, given the factors you've mentioned, and also considering inflation rate again, if it depends on how well we see inflation numbers go for 2021. So all these factors just tells you that we might likely see more participation in the market should these factors you mentioned continue.
And I'm just also wondering, yes, we're seeing that liquidity, we're seeing that confidence in the market, but many of these companies are still operating in a weak macro environment, including the banks. We've seen a drop in their interest income from their Q3 earnings. And I'm just wondering, would investors continue to stick with the big names, especially in the industrials and banking, those names that they know perhaps can still weather the storm, ignoring sectors like the ICT, for instance? Is that what we're going to see?
Well, we're likely to see that, despite the fact that their interest income has reduced. We've also seen their interest expense fall as well, and that's just largely due to the cut down in rate, saving deposit rates. So we think that would, on the one hand, while the interest income is falling, the moderation on interest expense will likely bode well for the banks. And we think that, in my opinion, we think that investors will likely still, play in the big names, say the GT Bank, the Zenith Bank, for instance, and those are stocks that still have the possibility of weathering. Those are companies that have the possibility of weathering the storm, and we see that there's possibly there's also potential for positive return if they buy into these sectors.
But for a sector like the breweries, I think you mentioned the breweries earlier on, they rely heavily on the consumer wallets, and of course a host of other consumer goods companies. We're seeing rising inflation and of course that much pressure now on the consumer wallet. So for the sectors like the breweries, we saw that price hike this year, I think, and I'm just wondering, how do they stay competitive going forward? We know, we always say innovation is going to separate the winners from the losers, but they're all still playing in a weak economic environment.
Okay, so a couple of them, I think, Nigerian breweries, for instance, I think they increased their prices. Some of them are, raising prices to, to still survive in the market. So while we may not see their performance coming as much, while we may not see them perform as well as they did in 2019, we think that employing factors such raising prices would largely help their top line and then filter into their bottom line as well. So that's what we're seeing drive this. And also for consumer wallet, yes, inflation is really high. A lot of people are reducing their spendings. And we think a pickup in activities, a gradual pickup in activities will bode well for the brewery space, especially for since H2 2020, we've seen that happen. We've seen increase in their quarterly numbers, and that's particularly for Nigerian breweries, even Guinness as well. We've seen them have better numbers compared to where they were in H1 2020, where we had the lockdown. So I think, despite the consumer wallet being depressed, it would still most of them will employ factors that will help them survive. Going forward.